Hello, this is Dr. Adam J. Bach. We're going to continue our conversation about financial planning and then discuss the challenge of growth. We've already covered some of the key topics here. We're going to talk a little bit about some of the metrics and then get into the cost of growth and the activity that you'll need to do. So the key metrics we're going to just talk about. Break even we're going to talk about very specifically. I'm going to mention ROI and ROE. Metrics for financial analysis are really more a component of a classic finance or a financial management course. I want you to just have some basic familiarity, that you know what some of them are or how to use some of them, because they are topics that will tend to come up in conversations with investors or strategic partners. And I believe that all entrepreneurs, especially tech entrepreneurs, have a responsibility for understanding some basic financial principles for how we measure financial success. So even though we're not going to go into these in any depth, there are issues that I think you should be aware of. So break-even is one of the simplest financial success metrics that there is, and it's probably the single most important one for new entrepreneurs to know. It's really straightforward. It's how many units do you have to sell to break even? That is, cover all your costs and avoid losing money. So our definition is it's the number of units that you have to sell in order for total revenue to equal total cost. It's break even when you go from losing money to making money because you're now selling enough product to actually cover all of your costs. Your textbook provides a mathematical explanation for it, which may or may not be obvious. It's presented there in a slightly different way than it's traditionally presented. This is how break-even calculation is traditionally presented, as total fixed cost over price per unit minus variable cost per unit. You can make this exactly the same as the equation in the textbook. If you're mathematically oriented, you could probably figure out the manipulation to do that. So you're welcome to give that a shot. You can also then figure out the break-even point in sales, which is simply the break-even point as number of units sold times how much you're charging. This may sound really complicated, especially if you're not a mathematically oriented person, but in reality, it's extremely straightforward. The challenge is usually figuring out which data to use. We're going to do a very, very simple example right now, just a truly painfully simple example, but it's the level that I'd expect you to be able to do. And I think once you see it in action, it'll make more sense, and then you'd be ready to potentially do more complicated versions of it. So we're going to imagine that we are going to be going to run a little food cart, specifically a hot dog type of cart, but of course, because this is Wisconsin, we won't be selling hot dogs, we'll be selling brats. And so there's a couple different factors we need to take into consideration. One is that we're going to need to rent the cart, and that costs us $80 a day. We pay that no matter how many brats we sell, $80 for the entire day, and we're done. And then, of course, we have some supplies. We're going to keep this very simple, where we only pay for the supplies that we use. In a more normal situation, we might have to buy a whole bunch of supplies and then hope we sell them all. But in this situation, we're going to pretend that either we can return the ones we don't use, or magically they appear as we need them, or something like that. And so it costs us $6 for each brat and bun. That's our variable cost, right? Because that's specific to how many we sell. If we sell one, then that costs us $6. If we sell two, that costs us $12. And then we're going to charge $10. These are apparently pretty nice brats, organic, grass-fed, locally raised beef and grain-fed pigs or something like that. And we're going to charge a fair amount for them. So they're $10 a piece. So what's our break-even point? So this is something that I would encourage you to try yourself before I begin to show you the actual answer. Take a moment, pause the presentation, and try it. It's not a very complicated calculation. You may be able to work through it without even using the actual equation itself. So pause here and see if you can do it. So here's our calculation. It's pretty straightforward. We're dealing with our total fixed costs divided by our price per unit minus variable cost per unit. Well, our total fixed cost is $80. Our price per unit is 10, and our variable cost is 6. So $80 divided by $4, which is effectively our profit per unit, and that gives us 20 units. So we need to sell 20 brats to break even. If we sell less than that, we're going to lose money. If we sell more than that, we'll make money. So for those of you whom this was very simple, you may not need to go through this process, but you can double check this. You can just walk through the process to figure out whether or not this calculation actually works, right? So what are our total revenues here? Well, we sold 20 brats at $10 each, which is $200. So that's our total revenue is $200. What about our total costs? Well, we had two kinds of costs, fixed and variable. Our fixed costs were $80. No matter what we do, our fixed costs per day are $80. And our variable costs are $6. So we sold 20 brats. $6 is cost for those 20 brats each, so that's $120. So our total costs are $80, fixed costs, plus $120 in variable costs is $200. And there it is. Our revenue is $200 and our total costs are $200. And so that's a quick double check just to make sure that this is working. Very briefly, just want to point out what ROI and ROE represent. These are mentioned in your textbook. You can easily go online to learn more about them, how to pull information off of the financial statements in order to calculate them. These are the classic measures of whether or not an organization is generating returns. Return on investment and return on equity. And they both use net income, which is the standard measure of profitability for an organization on a year-to-year basis. One simply compares how profitable is this to the amount of capital that's been invested. And that's a good measure for thinking about whether this has been a good investment over time. Return on equity is a little different. Early on in the organization, it might be similar if the amount of invested capital is the same as the owner's equity, but over time, those items do not match up. Return on equity is a way of examining how efficiently the organization's equity is being deployed to generate financial returns. And this is usually a measure that's then projected forward based on the organization's growth expectations. So I do want you to at least know what these two acronyms mean. It's not too difficult to pull the information that you need out of the financial statements in order to do these quick calculations. We now want to get into the cost of growth and set you up to do your big activity associated with all of this. The simple issue here is that business growth is not generally free. So let's think about this. Most businesses spend money before they make sales. For example, you set up an organization to make widgets. And when you sell those widgets, you'll generate income, of course. But before you begin selling them, usually you have to make them. And to make them, you have to do a bunch of things. You have to rent a facility. You have to hire employees and pay them. You have to pay for utilities and insurance and administrative costs. You have to buy the supplies, which might be gadgets, which then are brought into the facility. You have to buy machines and equipment to manufacture the widgets out of those gadgets. And then you have to distribute the widgets that you're selling and potentially pay salespeople and customer support people to interact with your customers. And all of that, a lot of that may happen, if not all of that may happen, before you actually get any revenue. And so the issue here is that most businesses require money in order to make money. And so the way you can think about this is that even once the company gets going, it always has to have a certain amount of cash available to it because it's constantly buying new stuff in order to make more stuff that it can sell. But if the company grows, then that means it's spending more money, and it's spending more money faster. And that means it needs more access to cash in order to fund all the things it has to pay for before it can generate new revenue. If you think about it, there's an interesting conclusion from that, which is the faster the growth, the more cash the company is likely to need. And here is the irony. We all tend to think in a tech entrepreneurship environment that growth is good. Growth is the faster you grow, the more valuable you are, and the more money everybody makes. And while in theory that is all generally true, it is also true that the faster a company grows, the more cash it requires simply to continue to function. Success can kill a company. Many businesses go bankrupt during their most rapid growth. It's one of the great ironies of entrepreneurship is that the most successful companies are also the ones at the highest risk of going bankrupt simply by running out of cash. So, my apologies there. I'm going to give you a challenge. I've generated a series of pro forma statements for a specific company. And it's not important what the company does. It has a couple of products and theoretically a service, and it generates income, and it's been running for a little while. And these Google Doc sheets, workbooks, are available for you to keep. And there are two links here for you to access. The sheets and technically are exactly the same. They're just set up with one variable differently so that you can see what's going on here. Open these up and you'll see that one of these, that this company has, there's two scenarios suggested, one in which there's 5% growth, and you'll see that at 5% growth, this company is pretty happy. It's generating money, it's growing and profits, and it's got cash, and everything is good. And then you can open up the second one, or you can just change the yellow cell that has the growth rate on it in the first one. And you'll notice that now we're going to grow this company 25%, and nothing else has changed. It's exactly the same workbook. All of the factors, all of the calculations, absolutely everything else is exactly the same. And yet now this company, despite the fact that it's growing wonderfully, which should be a good thing, it's going to be bankrupt in 5 years. So this is a scenario in which if we could imagine that this company has an opportunity to enter a new market, and its growth is going to go up very, very rapidly. If nothing changes as it grows, this company will run out of cash. Now, this is not that complex a spreadsheet. It may look pretty sophisticated, but it's actually not that complex. It is yours to play with. You can't ruin mine. You can't edit my copy of it, so you'll need to make your own copy of it. But your challenge is, can you save this company? And if so, what are the things you're going to have to do? I want to give you some guidance here and some advice. So first of all, the two workbooks are exactly the same. I just, in case you wanted to see one and then the other really quickly, I put both links on there. What you should do is make your own master copy and then leave that master copy alone and then create new copies that you can play with, right? Because you're going to there's probably going to come a point where you're going to want to go back to that master copy. You can always re-download my copy of it. That will always be clean, but it'll probably be easier if you just do it this way. Read the instructions on the first page. There's detailed instructions that walk through how the actual calculations work. This is a fully functional pro forma statement. The balance sheet is set up to balance itself automatically unless you mess things up. And messing things up is actually a lot easier than it looks. As the instructions show, you can pretty much change anything in a green cell that you want, and everything will be fine. Everything will still balance out. You can change the white cells, but if you change them in a way that doesn't fit with accounting principles, you will quickly discover that the balance sheet goes out of whack. And all you have to do is go to the balance sheet, and at the bottom there's a check line that's in green, and if you've screwed something up, that will turn red, and it will show you it will show you what year it first happened. Now, most of the time, if you're not a sophisticated financial person, you will be unable to find the mistake that you made. If you are checking that balance sheet constantly, you might spot it right away. But if you do change one thing and then you change something else, and a minute later you check the balance sheet, now it's almost impossible. And you may find yourself having to go back and starting all over again, which is perfectly fine. Note that some calculations are pegged to very specific assumptions that are shown in the spreadsheets. So for example, marketing is currently set to be 5% of sales. And any of those that are in the green cells you can change at will in order to see what happens. Note that some of the sheets show data for year 0. You should assume that those were last year and you should not mess with those. Those are sort of saying that's how the company looked and year 1 is going forward. Work with a colleague on this if you can. I know you may be working remotely, which is great, but call up a colleague in class or someone who understands this stuff and share the worksheet and then show what you're doing and talk about it. If you really want a challenge, set the growth rate to 50%. You'll discover that the company is dead way before year 5, and you might want to ponder how that happened. So your goal is to save this company. And what does it mean to save the company? Well, it means that this company has to have positive cash at the end of year 5. And you can see that on the summary page, or you can see it on the cash flow statement. You can even see it on the balance sheet because everything carries through properly. Your goal is to save this company. What are you going to have to do financially? Now, the challenge here is going to be once you figure out how to save the company financially, you're going to have to think about what that means operationally. So In Canvas, there will be an assignment to complete in which you will put in the URL for the sheet for your own copy of the worksheet that shows your solution. So make sure you set that to public sharing so that I can see it. And then you're going to identify the things that you changed and why you think they work. And then you'll need to talk about also, if that is the way to solve this problem, what would you actually have to do in order to make that work? And I'm going to give you a hint right now. I'm expecting you to find at least two kinds of solutions here. One is a purely financial solution, and the other one is an operational solution. So if you remember back to the cash flow statement analysis that we looked at from the last presentation, and there's financing and operational cash flows, I am expecting to see a little bit of each of those as you figure this out. Okay, here's what's going to happen now. There's a blank page in this presentation. I encourage you, go and work on this. This is going to take some time. Normally we spend almost an entire class session just on this activity alone. So you should expect to be spending 20, 30, 45 minutes on this. Working with a colleague, you may discover you can do it more quickly. But the page after the blank page and the end of this presentation, I'm going to give you some hints. But I really think you'll do better if you try it on your own before you come back and get the hints. The hints are here for when you need them, but go on and try this first before you come back and get some guidance, okay? It's perfectly fine to get it totally wrong. No one's going to know. Play with the spreadsheet. Learning how to work with a pro forma financial analysis is a really valuable skill for anyone to have, even if just for the familiarity of getting used to what these financial statements look like and what happens when you change things in them. Okay, so go ahead, give it a try, play around with it, call a colleague, and then if you need some help, or once you think you've got a solution, come back and listen to the hints and then see if that gives you any more guidance. And one last thing is I'm expecting there should be an online session scheduled to review the results. Please check Canvas to see. There should be an announcement about that in which I'll be available in real time to walk through a few elements of the workbook and the way that you can solve these problems. So hopefully you've taken a shot at this already. If you haven't, I really strongly encourage you take a crack at it before you listen to the hints. But on the assumption that you've done that and maybe you've solved it or maybe you haven't, here are some things that you want to think about. So anytime that a company needs more capital, one thing that you could do is obtain some outside capital. And so you could assume that one way to solve this problem is to raise money, one way or the other. And if you do raise money, where does that go on the pro formas? Well, it depends partly on whether it's going to be debt or equity. Are you going to get are you going to get a loan? Are you going to raise money from potential investors? And so a key question is, if that's what you're planning on doing, one, the other, or possibly you could do a little bit of both, and it's interesting to see what the implications are. Where does that money go on the pro formas? And part of the trick here is remembering the difference between the fact that the balance sheet is a snapshot, the cash flow statement and income statements are time-based. So you probably, if you put this stuff in the wrong place, things will go badly quickly. Your balance sheet will get out of balance fairly fast. You may also discover that entering these in requires you to think carefully about what happens the next year. So take a shot at that and see how you do. If, however, you want to think about some of the operational ways that you could fix this problem, you have to think about what are the key operational factors that determine how much cash the organization uses. And here is where you're going to want to think. You may think about things like purely operating costs. For example, from the presentation, you might have thought, oh, well, I'll drop the marketing cost from 5% to 4%. But then you need to think about what implications that has. If you lower marketing costs, wouldn't you also expect your sales to go down? So if you simply came up with a solution in which you reduce the operational costs of the business by, for example, cutting sales and marketing expenses, or maybe you tried to reduce costs of goods sold, you have to think about what kinds of actions and implications that would actually have. Reducing your marketing costs only helps you if you don't reduce your sales costs. And that may not be a viable assumption. Can you really lower, for example, your costs of goods sold? That is, how much you pay for materials. But there are some other things that you can think about that are at least partly under your control. Inventory is simply cash sitting in your organization in the form of stuff. And the question is, how much inventory do you need at any given time? So that might be something that you could look at in the spreadsheet to see where you can go with that. Receivables are how much you're owed by your customers. Well, if a customer owes you money, it means you've already sold them something and perhaps delivered it. If they still have your money, that means that you are missing cash in your organization. So reducing your receivables will bring more cash into the organization by transferring money from your customers, who for whatever reason aren't paying you, into your organization. By contrast, payables are how much you owe your suppliers. And here the opposite is true. If at all possible, you'd like to delay paying your suppliers because that holds cash inside your organization. So here, those are some things that you probably want to take a look at and see if you can adjust. But you need to think about what the implications of those are as well. You can't just say, I'm going to have less inventory. Less inventory means that you might not be able to fulfill all your orders. And there are similar implications for receivables and payables. Think about your interactions with your customers and your suppliers as you attempt to manage those. And then finally, if you're really, really advanced, there's the third area of the cash flow statement, which is your investing activities. And you could take a look at what on earth is happening with your plant, property, and equipment and capital expenditures. That happens over on the capital expenditures page. And I'm not going to tell you what's going on there, but if you can figure it out, you might be able to propose a way to help with the cash flow situation based on the way that the company is managing its plant, property, and equipment. But that's a much more advanced topic. You're welcome to ignore that one, but if you feel like you've made progress here and you're interested, you're welcome to delve into that in a little more detail and see if you can figure it out. So I'm hopeful that you'll find this activity to be interesting and maybe fun. But at the very least, it should be getting you very much immersed in the nature of entrepreneurial finance and understanding how the financial statements and pro forma projections actually work.